Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And the biggest news nobody's watching right now are 3 little changes snuck into the big beautiful bill passed in June. 3 changes that could see a $58 billion cash boost at 5 companies alone, pushing those stocks up between 20 and 168%. I'll highlight those changes, reveal the 5 stocks to buy, including Amazon, that could see a 70% bump. Stick around and I'll update our market outlook as well as important updates to shares of the Trade Desk, Circle Internet Group, and Symbotic. But first, these Monday market updates get you updated for the week, but the way the market has been lately, sometimes you need your news now. For a daily recap and some great commentary on everything from the economy to markets and even a little stonk talk, check out the Market Briefs newsletter delivered to your inbox free every morning before the market opens. The newsletter is from Jaspreet over at the Minority Mindset channel. I've known Jaspreet for years and his team always puts together solid videos and now a must-see newsletter. So I'm going to link to both Jaspreet's channel and the Market Briefs newsletter in the description below. It's totally free, so make sure you click through and check that out. Back to our main topic though, and tax law isn't something I usually get excited about, but 3 changes in the big beautiful bill are about to make companies and investors $148 billion richer. And that's just enough to get me excited. Now, these changes affect how companies depreciate assets, expense R&D costs, and then report that interest expense, all 3 of which can be used to lower the amount of taxes paid. For example, instead of having to spread research costs over 15 years, companies are going to now be able to take all those costs at once to lower their reported income and taxes owed. Hey, I said it was a yawner, but bear with me because it's going to cause cash flow to explode over the next few years. Cash flow that could find its way back into your pocket through buybacks, dividends, or just a higher stock price. And the best part is here, Wall Street hasn't caught on yet. For example, Amazon is expected to save an additional $15.6 billion in cash from these changes, but the stock is flat since June 30th when the bill was signed into law. Amazon has generated $13.4 billion in free cash flow over the last 12 months, meaning this boost could more than double that amount. And that is important because free cash flow, or FCF, is one of your truest measures of cash left over for investors. While everyone fixates on the income statement from revenue down to net earnings, management has more accounting tricks to fake profits than Nancy Pelosi has burner phones. Cash, on the other hand, is harder to fudge. The statement of cash flow shows actual cash in and out of the company. Operating cash is the cash generated by that core business, and take that and minus the amount of investing cash needed to keep the lights on, and you've got free cash flow. In theory, that's the amount of cash that could be passed out to investors and the company would keep on going. And here, research by Science estimates just within the S&P 500 companies, the boost from the BBB changes are going to increase that cash flow by $148 billion, about 8.5% higher than estimates before the bill. But that money isn't spread around evenly. Just 5 of the stocks account for $58 billion of that, or about 39% of the benefit. Analysts had penciled in over $36 billion in free cash flow for Amazon this year. Add in that $15.6 billion windfall, and that means almost $52 billion in cash for investors. Right now, shares trade for just 16.8 times on that price to cash flow measure, under the 5-year average of 20 times cash flow. So if that valuation increases to that 20 average on a rebounding investor sentiment, and we see a 43% boost to cash flow, that translates to a 70% upside in these shares. And Amazon isn't even the biggest winner in all of this. Alphabet, ticker GOOG, is expected to see cash savings of $17.9 billion from these changes. That would be a 27% bump from the $66.7 billion in free cash flow over the last year. The shares here at 17 times price to cash flow are trading just under their 5-year average, but assuming that average means a 33% upside to the stock. And I continue to say that this stock has a lottery ticket in its Waymo unit, could be worth way more. Shares of Microsoft, ticker MSFT, are up 23% this year on solid growth in just about every segment, and here the company is forecast to see a $12.5 billion cash windfall from these changes, almost an 18% increase to its $71 billion in free cash flow reported. The shares are trading a little expensive here at 27 times on a price-to-cash flow ratio versus that 5-year average around 26 times cash flow, but have been as high as 32 times in the past decade. Even on that lower price-to-cash flow ratio, though, which would be a drop of 6% in the shares, would still be 17% higher on that cash flow increase. Meta Platforms, ticker META, could see an $11 billion boost on its free cash flow, an increase of 22% to the $50 billion in free cash flow it reported over the last year. Shares are the most expensive here relative to its own average, trading at almost 20 times price to cash flow versus an average of just 14.4 times over the past year. But even if this stock were to drop to its 15x valuation multiple, a 25% decrease, the shares would still be worth 16% more on this increase in cash flow. But here the biggest winner could be Charter Communications, ticker CHTR, which just spooked investors with disappointing earnings, pushing the stock to an 8-year low. Analysts believe Charter could see a 39% boost to its free cash flow from this bill, the highest increase in the communication services sector, equating to about another $1.7 billion in cash from its current $4.3 billion estimate. The drop has taken shares to just 2.4 times on a price-to-cash flow basis, a huge discount to the average 4.6 times cash flow ratio it's traded at over the past 5 years. Now, it may take a while for investors to return back to that 4.6% valuation multiple, but that would be a 93% higher, then times the 39% cash flow boost, pushes this one up 168% from here. Other winners here include Targa Resources, ticker TRGP in energy, Huntington Ingalls, HII in industrials, Texas Instruments, TXN for tech, Dollar Tree, DLTR in consumer staples, Nucor, NUE in materials with a 41% cash flow boost, Insight Corporation, INCY in healthcare, and then FactSet, FDS in the financial sector. And Nation, this doesn't just extend to those individual stocks, but should keep the market and that AI theme alive as this all plays out. Those tax changes create those cash savings through depreciation and expenses, so companies are being incentivized to invest and spend on that research and development. Since a lot of these companies don't spend much on their dividends or share buybacks, it's going to mean that extra cash goes into even more capital investment over the next few years. Turning it now to the stocks I'm watching this week, the Trade Desk, ticker TTD, got slammed Friday on earnings, so down as much as 39% before clawing back just a few percent. Like a lot of the stocks we've been following, earnings were not that bad, with revenue up 19% to $694 million, beating expectations, and while management guided to $717 million in current quarter sales, which was in line with analyst estimates, it does mean just 14% growth, so they're forecasting a slowdown here. Now, I'll talk through this report and the fears, but we've seen this same scare before after the fourth quarter report in February, when I started loading up on these shares, building to a 3,500 share position with Friday's buy on the dip. The stock jumped 70% off the April low and was added to the S&P 500 index in July, and I think it gets back that way within a year. The company is a leader in advertising tech, serving the $935 billion market and dominating in the connected TV vertical, one of the fastest growing segments. The Trade Desk platform provides the best ad tracking and reporting, helping it to grab a larger share of the market spending versus agencies and other solutions. Now, online and CTV ad spending is only growing higher, and Trade Desk is positioned for that, but did point out some slowing in enterprise ad spending driven by tariff uncertainty and a slowing economy. Now, I think it's being overly conservative on the forecast, something we know management has a tendency to do, so it can beat expectations in nearly every quarter, but we know the economy is a headwind at this point. Investors have also been worried about competition, especially from Amazon since February, and while the first quarter results in May didn't show any pressure and saw the shares pop higher, the fear was back last week. Even against economic headwinds and the potential for competition, though, the company is still forecast at 17% growth this year and next, and I think it beats even that. Friday's crash takes it to a $27 billion market value, or just 9.5 times on a price-to-sales basis. That is less than half the 25x multiple it traded at over the past, and even below the low we saw over the last few months at 11 times price-to-sales. Folks, this is still a company with a competitive advantage in a growing industry. My one-year target of $78 per share is based on a 3% beat for full-year sales to $2.95 billion, a 13x multiple on the price-to-sales ratio for a 40% upside. And that is a conservative estimate, with future growth taking it even higher. Circle Internet Group, ticker CRCL, reports this week for the first time since it went public in June, with the shares down almost 50% from the peak, but still 84% higher than that first day open. Now trading at 18 times price to sales, but only about 13 times this year's expected sales of $2.6 billion. It's not as ridiculously expensive as it was when I said to avoid it at $250 a share. It's not too expensive for a company expected to grow revenue at a 30% pace, and with the potential to be the ground floor of the stablecoin era. Now, that's a market that could be as high as $3 trillion just over the next few years, according to McKinsey, and could go even higher with tokenization of the money market accounts. That would be a giant growth from the $240 billion stablecoin market today, of which Circle's USDC has a strong 25% market share. But here, profitability is always going to be the issue because these stablecoin companies are very limited to how they make money, by putting their money that you pay for those stablecoins mostly in US Treasuries, with a small kicker in those money markets and a few other investments. Almost all of that money has to go into treasuries for that safety and to maintain the peg to the dollar, but that means the company is only making about 4.5% on the majority of its money, and is why it only converts about 11% of its revenue into net income. What you have here, folks, Circle is basically a bank taking your money as a deposit and then lending it back to the government for about 4%, which means this growth stock part of it, that part investors are willing to pay 13 times its sales, is all in that growth in the stablecoin market. I'm also watching networking stocks, which boomed last week, with Arista Networks ticker ANET up 18% and Astera Labs up 32%. And I would be picking up more shares of Broadcom, AVGO, into its report September 3rd, as it looks like the data center money is now flowing into that networking theme that I've been talking about. The hyperscalers continue to increase their AI investment budgets, now at $365 billion just from 4 companies this year. And while chipmakers have gotten all the love, it's the networking infrastructure within data centers that is going to be the real bottleneck, where the biggest upgrade needs to be happening to handle all that data center traffic. The global data center networking market is forecast to grow 240% through 2033, and I think even that is underestimated. Of the 3 stocks here, ANET and ALAB are those pure play companies in that networking theme, while Broadcom has accelerator chips and other segments that makes it one of the best all-around data center stocks you can buy. But then Cisco Systems, ticker CSCO, could get some of that love too when it reports earnings on Wednesday. And this company was networking when networking still meant putting on a suit and passing out business cards. Cisco's hardware isn't the talk of the town anymore, and it's only expected to post 7% revenue growth for the most recent quarter and 5% full year, but relatively low valuation at 5 times price to sales, and booming growth in that overall networking industry could see this one surprise on the upside with revenue and send the stock higher. Symbotic, ticker SYM, also took a giant dump on earnings, falling as much as 23% on the day, but still managing to close up 6% on the week. Like many of the stocks that got hit last week, earnings were actually really good. Revenue was up 26% to $592 million, and way above the $533 million expected by Wall Street, with EBITDA earnings of $45 million, beating the earlier guidance by 36%. Now, the disappointment came on management's guidance for current quarter revenue of $600 million, which was below analyst expectations for $636 million, and due to a shift to the next-generation storage structure the company is transitioning to this quarter. Management said there could be some short-term impact for revenue this quarter, but it doesn't affect the long-term growth or the company's backlog of $22 billion in orders. Now, that backlog supports years of 20% plus growth, and at a 15 times this year's sales forecast of $2.2 billion, Symbotic is still on track to revolutionize the $1.2 trillion warehouse market. Even after the drop, I'm up 121% on my position and adding more on this dip to those higher prices. Showing you that bigger picture here with the Sector Spiders sector tracker, 8 of the 11 stock sectors did close higher last week, but again, we saw some extremely lopsided returns, with just 3 sectors, consumer discretionary, consumer staples, and communication services, really carrying the market. Nearly half of the gain in the consumer discretionary sector was due to Tesla, which is a 16% weight in the group and up 9% on the week, but the group did see widespread gains as well, with 28 of the 51 stocks closing higher. Stocks in the consumer staples sector also did exceptionally well, with 31 of the 38 stocks in the group closing higher, all a good sign for the consumer and the economy. Energy stocks were again the big laggard last week, with just 7 stocks of the 22 in the group closing higher after oil closed down more than 5% on the week to $63.50 per barrel. With the exception of the tariff scare sell-off in April and May, this has been the low end of the range for oil prices, signaling we should see some support unless the economy totally nosedives. Now, the Israel-Iran ceasefire has held so far, but with Israel's recent decision to fully occupy Gaza City, the odds of another outbreak that sent oil spiking to $75 a barrel in June are higher again. Shares of the Energy Select Sector Spider Fund, the XLE, and the stocks within it are priced attractively, with the floor of the support on oil and potential for a pop on any new hostilities. Updating our market outlook, earnings are all but over, with 90% of the companies in the S&P 500 having reported. Overall, the results would paint a strong picture, with an average 11.8% profit growth and 81% of the companies beating expectations. There was particular strength in communication services and tech companies, reporting 45% and 21% earnings growth, while 2 sectors, materials was down 3.7% and energy down 17%, saw their earnings fall on average. Now, of course, the biggest trend that we've been following is the giant sell-off in any stock that hasn't just blown away expectations. Even stocks beating forecasts by as much as 5% have seen their shares fall by almost 1% on the news. and stocks missing by more have crashed by 10 and 20% or more on the day. It's a theme we see at least once a year when the market and its expectations get extended, but that massive sell-off usually becomes a buying opportunity as those estimates get reset. Companies come back with positive surprises in the following quarters. This week we'll see the all-important Consumer Price Index, the CPI, report on inflation on Tuesday, with expectations to show that tariff-related pricing pressures do continue. The core inflation report that strips out food and gas is expected to show 3.1%, with even the headline number up versus last month. Now that isn't going to change market odds of a rate cut much for the Fed's September meeting, now at 90% probability that the central bank will cut by 0.25%, but it isn't going to help investor sentiment any, and it's likely to put further rate cuts in question. The CME Fed Watch tool shows markets are pricing in about a 55% chance of an October rate cut and another shot in December, but persistently high inflation could take those off the table. President Trump is putting Stephen Moran in as a Fed governor and is going to get another vote for a rate cut at its meetings, but the rest of the Fed is still independent and not likely to cut too far if inflation stays high. We're also going to see the producer prices measure of inflation on Thursday, likely to back up the idea of those higher prices, and then retail sales data on Friday, which is expected to show that consumer spending is weakening slightly. And none of this is very good for stocks, that high inflation and slowing growth. With earnings on the back burner, the market is going to have to look for other reasons to send stocks higher. August and September are typically the two worst months for stocks, with September often the start of a correction. Now, overall, fundamentals do look good, and investors continue to buy the dip, but we could still see some of that give back of the giant 28% run we've seen since April. Look for the link in the description and get your news every day before the market opens with market briefs, free with the invite link below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.